In just 72 hours, silver crashed 31% in its worst day since 1980. Gold lost nearly $1,000. Bitcoin plunged below $75,000. And this morning, as you're listening to this, hedge funds are quietly pulling billions out of North American assets. If you think this doesn't affect you because you don't trade precious metals, think again. What's happening right now is the early warning signal of something much bigger, and most investors won't see it coming until it's too late. I'm going to show you exactly what's happening, why the world's reserve currency has become dangerously unpredictable, and most importantly, the specific actions you can take in the next 48 hours to protect your portfolio. Let me take you back to Friday, January 30th, 2026. It started like any other trading day, but by market close, financial markets had experienced what traders are now calling the Warsh shock. Here are the numbers, and they're verified. Silver plummeted 31.4% to settle at $78.53 per ounce, its worst single day since March 1980. Gold crashed 9%, losing roughly $450 in a single session, trading down to $4,895 per ounce. Bitcoin dropped below $75,000, its lowest level since April. The dollar index surged from its 4-year low of 95.5 to above 97.6. But here's what the headlines didn't tell you. This wasn't just about precious metals. This was the moment the global financial system realized that the dollar, the world's anchor currency, had become fundamentally unpredictable. What actually triggered the collapse? At approximately 5 p.m. EST on January 30th, President Donald Trump announced his nomination of Kevin Warsh as the next Federal Reserve Chair, replacing Jerome Powell, whose term expires in May 2026. Who is Kevin Warsh? He's a former Fed governor who served from 2006 to 2011 during the global financial crisis. But here's what matters. Unlike the expected nominee, Warsh is viewed as an institutionalist who would defend Fed independence. Markets had been betting on someone who would bend to political pressure for rate cuts. They got the opposite. The dollar strengthened immediately, and when the dollar moves sharply in either direction these days, everything else breaks. The trade that imploded. For over a year, one of Wall Street's most popular trades was built on a simple premise. Fed independence would be compromised, the dollar would weaken steadily, and hard assets like gold and silver would soar as inflation hedges. By mid-January 2026, positioning in gold had reached an 8-year high. Retail investors poured record amounts into silver ETFs. Traders borrowed heavily to amplify their bets. This is what we call a crowded trade. As Société Générale noted in the client report, this currency debasement concept dropped out of metals markets at lightning speed once Warsh was nominated. When everyone's on the same side of the boat and the boat suddenly turns, people get crushed. That's exactly what happened. Why this matters more than you think. Here's the critical insight. This wasn't a normal market correction. This was a liquidity crisis triggered by currency volatility. According to Capital Economics, the dollar has become detached from traditional valuation metrics like interest rate differentials. Barclays calculated what they call a US policy risk premium, meaning the dollar is now influenced more by White House rhetoric than by the economic fundamentals investors normally track. When a reserve currency stops behaving predictably, everything priced in that currency becomes harder to value and hold. That includes your stocks, your bonds, your real estate investments, everything. The $10 trillion a day question. The foreign exchange market trades nearly $10 trillion every single day. It's the largest financial market in the world, and it's experiencing volatility we haven't seen in years. A gauge measuring expected 3-month volatility in the euro-dollar exchange rate hit its highest level since July 2025, just last week. For context, when currency volatility spikes, it ripples through every other asset class. Here's why. Every international investor has to think about two things: the return on their investment and what happens when they convert that return back to their home currency. If currency moves wipe out your investment gains, what's the point? The smart money is moving. This is where it gets really interesting. According to Reuters reporting from February 2nd, 2026, confirmed by prime brokerage reports from Goldman Sachs and JP Morgan. Hedge funds have been systematically reducing their North American exposure over the past year. Let me give you the specifics. Europe is seeing massive inflows. 34% of allocators are increasing European allocations across equity long-short, event-driven, and credit strategies. European long-short equity managers are generating alpha that sets them apart from many US counterparts. Several European equity funds have hit capacity. Helicon Investments closed at $8 billion. Kingsbury Capital imposed restrictions near $3 billion. Asia is back in favor. 30% of allocators are increasing Asian exposure. Interest in Asia-focused strategies has risen to levels not seen since 2022. China-focused hedge funds are experiencing a turnaround. 9% of allocators invested in 2025, with another 14% planning to in 2026, up from a 42% net reduction in 2023. What are they fleeing from? Trade policy uncertainty, mega-cap concentration risk, and here's the key: dollar volatility that makes US assets harder to value. As one hedge fund strategist told Reuters, the main question is whether people lose confidence in the US asset base. The Warsh paradox. Now here's where this gets fascinatingly complex and where you need to pay very close attention. Kevin Warsh is simultaneously being interpreted in completely opposite ways by different market participants. This creates massive opportunity for informed investors and devastating risk for those who aren't paying attention. The hawkish interpretation. Warsh favors tighter monetary policy. He wants a smaller Fed balance sheet. He's skeptical of easy money policies. This means higher rates for longer, which is bad for risk assets. The dovish counter-argument. Economist Robin Brooks from the Brookings Institution, who correctly predicted Japan's fiscal crisis, argues Warsh will actually cut rates aggressively. Brooks predicts 100 basis points of cuts across 4 meetings in June, July, September, and October. His reasoning? Warsh's worst nightmare is probably to have Trump turn on him like he did on Powell. Brooks believes Warsh will cement a high productivity, low inflation narrative to justify lower rates, positioning the AI boom as a disinflationary force. If Brooks is right, this could mean the Fed's benchmark rate drops from the current 3.5% to 3.75% range to 2.5% to 2.75% before November's midterm elections. Who's right? Nobody knows yet. And that uncertainty, that's the problem. That's why volatility is exploding. The real numbers right now. As of this morning, Wednesday, February 4th, 2026, dollar index, DXY, 97.62, holding relatively steady after the surge. Gold, recovered to around $4,935, up 6% from its lows as the dust settles. Silver, attempting to stabilize but down massively from recent peaks. Bitcoin, trading around $78,226, still searching for support. Fed funds rate, 3.5% to 3.75%, with markets pricing in 2 potential cuts this year. The market is still trying to figure out what this all means. But while everyone else is confused, informed investors are taking action. What the currency chaos reveals. According to Morgan Stanley's chief US equity strategist Mike Wilson, we need to watch 4 critical signals to understand if dollar confidence is truly eroding. Are inflation expectations rising sharply? Currently, no. Market expectations for CPI inflation over the next decade are about 2.4%, similar to 2023-2024 levels. Are we seeing more volatility in government debt? Actually, expected volatility for US interest rates over the next year is lower than it was on January 1st. Has the dollar's valuation deviated dramatically from fair value? Based on purchasing power data from Bloomberg, the dollar is actually trading roughly in line with fair value despite recent headlines. Are credit markets showing early signs of stress? Across multiple regions, credit spreads remain historically tight, not flashing warning signals yet. Wilson's conclusion: the current run-it-hot approach has a better chance of delivering sustainable growth than prior policy mixes. But it won't be smooth, and confidence will ebb and flow along the way. The currency war nobody's talking about. Here's a dimension most commentary is missing. We're witnessing the early stages of a potential reserve currency realignment. For the past 2 years, BRICS plus nations and central banks worldwide have been aggressive buyers of gold. This was part of a broader de-dollarization movement driven by concerns about US fiscal policy and geopolitical tensions. The sudden dollar resurgence under a potentially hawkish Warsh-led Fed proves that the greenback's demise may have been greatly exaggerated, as one market analysis noted. This shift has massive ripple effects on global trade and commodity pricing. But here's the tension. While the dollar strengthens in the short term, the underlying drivers of de-dollarization, trade policy uncertainty, intervention in foreign affairs, massive US fiscal deficits haven't gone away. What professional money managers are actually doing? Let me show you specific, verified actions that sophisticated investors are taking right now. These aren't theoretical strategies. These are real portfolio moves happening this week. 1. Multi-asset managers are going neutral. Oliver Blackburn at Janus Henderson Multi-Asset Management said he's shifting portfolios towards a neutral stance to back away from market risk and has cut exposure to both stocks and gold in the last 2 weeks. His quote, "If the dollar is more volatile on the back of various policy pronouncements, then other assets are going to be volatile on the back of that. So we'll just have to get more neutral in the short term." Translation: when you can't predict currency moves, reduce your directional bets. 2. Option strategies are protecting against both directions. John Stopford, head of managed income at 91, is using a specific strategy worth understanding. He bought both. Put options that profit if treasury yields rise, betting on a hawkish Fed. Call options that profit if yields fall, betting on a dovish Fed. His explanation: to cover the uncertainty over the likely direction of yields from here. This is called a straddle strategy. You're paying for protection in both directions because the uncertainty itself is the risk. 3. The geographic diversification play. Based on prime brokerage data, here's what's actually flowing where. Into Europe. Long-short equity strategies capitalizing on increased dispersion. Event-driven funds benefiting from M&A activity. Credit strategies taking advantage of restructuring cycles. Into Asia. Japan event-driven plays. M&A activity in the first half of 2025 was $232 billion, triple the 2024 volume. China turnaround plays as regulatory environment stabilizes. Market-neutral strategies exploiting local inefficiencies. Out of North America, concentrated mega-cap tech exposure. Long-only growth strategies leverage precious metals trades. The strategies that failed learn from others' mistakes. Let's talk about what not to do based on what just blew up. Failed strategy number 1, the leverage metal trade. Traders borrowed heavily to buy silver and gold, assuming smooth Fed policy and steady dollar weakness. When volatility spiked, margin calls forced liquidation at the worst possible prices. Matt Maley, equity strategist at Miller Tabak. Most of this is probably forced selling. This has been the hottest asset for day traders and other short-term traders recently. So there has been some leverage built up in silver. With the huge decline today, the margin calls went out. Lesson: leverage amplifies not just returns, but also the risk of catastrophic loss during volatility spikes. Failed strategy number 2, the crowded consensus trade. By mid-January, sentiment indices showed positioning in gold at an 8-year high. When everyone's positioned the same way, even good assets can collapse as positions unwind. Katie Stoves from Mattioli Woods. When everyone is leaning the same way, even good assets can sell off as positions get unwound. Lesson: extreme positioning creates its own risks, independent of fundamental value. Failed strategy number 3, ignoring currency risk. Many international investors focus solely on US asset returns without adequately hedging dollar exposure. When the dollar spiked, it either wiped out their gains or amplified losses. Lesson: in a volatile currency environment, currency hedging isn't optional. It's essential risk management. Your action plan, the next 48 hours. Based on everything we've covered, here are specific actionable steps ranked by priority. Immediate, today, audit your currency exposure. Calculate what percentage of your portfolio is denominated in dollars. Identify any unhedged international investments. Assess your indirect dollar exposure, commodities priced in dollars, etc. Review your leverage. Check if you're using margin in any accounts. Identify positions that could be vulnerable to margin calls. Consider reducing leverage before the next volatility spike. Check your asset concentration. Are you overweight US megacap tech? Do you have geographic diversification? Is your portfolio structured to handle currency volatility? This week, consider protective options for substantial equity positions. Look at put options for downside protection. For fixed income, consider treasury options in both directions, like 91. Don't speculate. Use options as insurance, not profit centers. Evaluate geographic reallocation. European equity funds with proven track records. Asian event-driven opportunities, particularly Japan. Multi-strategy hedge funds that can trade across regions. Build dollar hedge positions. Currency hedged international ETFs. Assets negatively correlated with dollar strength. Consider allocating to currencies with positive carry, higher interest rates. Next 30 days, shift toward active management. In high dispersion markets, active managers can add value. Look for managers with demonstrated ability to navigate volatility. Multi-strategy hedge funds are seeing record inflows for good reason. Increase liquid alternatives allocation. Market neutral strategies. Discretionary macro funds, which delivered strong 2025 returns. Credit strategies that can go both long and short. Create a currency volatility plan. Define your policy for hedging ratios. Establish triggers for when to increase or decrease hedges. Don't try to predict currency moves. Manage the risk systematically. The indicators to watch. Don't just react to today's news. Watch these specific leading indicators to stay ahead. Weekly. Dollar index, DXY. Breaks above 100 or below 95, signal major moves. VIX, Volatility Index. Sustained readings above 20 indicate rising fear. Euro US dollar implied volatility. Leading indicator for currency stress. Monthly, Fed communications. Every wash statement will move markets. Read the actual transcripts. Prime brokerage flows. Follow Goldman Sachs and JP Morgan hedge fund positioning reports. Credit spreads. Widening spreads are the early warning system for stress. Quarterly, international reserve data. Are central banks still buying gold or shifting back to dollars? Hedge fund flow data. Which regions are seeing net inflows? Corporate earnings with significant FX impact. Real-world effects of currency moves. Here's what most people miss. Volatility creates opportunity, but only for those who are prepared. According to the 2026 Hedge Fund Outlook from BNP Paribas, hedge funds delivered 641 basis points over cash in 2025, 10.53% returns. 64% of allocators plan to increase hedge fund exposure in 2026. This could translate to $24 billion in additional net inflows. Why? Because hedge funds delivered plus 2.13% alpha versus MSCI World in 2025, despite or because of the volatility. The strategies performing best: discretionary macro, up 10.81% in 2025, with 21% of allocators expecting it to deliver the highest returns in 2026. Quant equity, 11.31% 5-year annualized return. Quant multi-strategy, 12.76% 5-year annualized return. These strategies thrive in exactly this environment: high dispersion, currency volatility, policy uncertainty. Let me give you the 3 most probable scenarios and how to position for each. Scenario 1, the wash rally, 30% probability. Wash cuts rates aggressively, 100 plus basis points in 2026. Dollar weakens systematically. Risk assets rally, gold rebounds. Positioning: overweight equities, commodities, emerging markets. Scenario 2. The hawkish surprise, 35% probability. Warsh maintains higher rates to preserve institutional credibility. Dollar strengthens further. Valuation compression in growth stocks. Positioning. Quality value stocks, dollar-denominated bonds, financial sector. Scenario 3. Continued uncertainty. 35% probability. Policy signals remain mixed. Volatility stays elevated across all assets. Correlation structures break down. Positioning. Market neutral strategies, options-based protection, geographic diversification. Notice I'm not telling you which scenario will happen. I'm telling you how to be prepared for all three. Let me be very direct with you. We are in a new regime. The dollar spent 2025 declining 9.4% as the DXY fell to 4-year lows. Then in 72 hours, it spiked back up, destroying trades worth billions. This isn't normal market behavior. This is a reserve currency in transition. According to Barclays Global Head of FX and EM Macro Strategy, Themos Fiotakis, the critical question is whether people lose confidence in the US asset base. So far, as Morgan Stanley's data shows, we haven't seen that confidence break. Credit markets are stable, inflation expectations are anchored, the dollar trades near fair value, but the risk is real, and the warning signals are there. Over the next 30 to 90 days, we'll get clarity on several critical questions. Senate confirmation hearings for Warsh. His testimony will reveal his actual policy intentions. First FOMC meeting under Powell's final months. Will there be a policy shift before Warsh takes over? Corporate earnings season. We'll see the real impact of dollar volatility on multinational earnings. International central bank responses. Will other central banks adjust policy in response to Fed uncertainty? Each of these events will create new information. Each will move markets. The investors who survive and thrive will be those who understand the forces at play, have prepared their portfolios for multiple scenarios, manage risks systematically rather than reactively, stay informed without being paralyzed by uncertainty. Here's what I need from you. Don't close this tab and forget about it. Don't think I'll deal with this later. The actions I've outlined aren't theoretical. They're what sophisticated money managers are implementing right now. You don't need to make every change today, but you do need to start. Pick one action from the immediate list, execute it today, then move to the next. Because here's the reality. The next major dollar move in either direction is coming. It might be triggered by Warsh's Senate testimony. It might be a geopolitical shock. It might be an economic data surprise. But it's coming. And when it hits, it will be too late to prepare. The option premiums will be expensive. The liquidity will be thin. The bid-ask spreads will be wide. Today, while markets are digesting the Warsh shock but before the next catalyst, you have a window. Use it. The dollar disorder we're witnessing isn't just a currency story. It's not just about gold and silver crashes. It's about the fundamental repricing of risk in a world where the anchor currency has become unpredictable. Hedge funds are pulling billions from North American assets. Professional money managers are hedging in both directions. Geographic diversification is accelerating at a pace we haven't seen in years. These aren't panic moves. These are calculated adjustments to a new reality. Currency volatility is now a first-order risk that affects every asset class, every portfolio, every investor. You can ignore this and hope your portfolio survives the turbulence. Or you can take action based on what the smart money is actually doing. The choice, as always, is yours. But the window for easy adjustments is closing. This is your wake-up call. Not in 6 months when the crisis is obvious. Not when hedge funds are already positioned. Right now, while you still have time to act. Because in markets, as in life, the difference between success and failure often comes down to timing. And your timing starts now.